Hello, everyone, and this is Sergio Morero here at Rebel One Live. We are excited to welcome our next guest, Carlos Antequera, who is co-founder and managing director of Nobel Growth Partners. Thanks for joining us today, Carlos.
Yeah, thank you, Sergio. So it's great to be here. Thanks for the invitation, and really looking forward to the conversation today.
Yeah, absolutely. So am I. So just so the audience knows, I'll give a little background on Carlos. He's a emerging fund manager who graduated with his MBA from the University of Kansas. He's based in Kansas City. He's an entrepreneur and launched a startup called Tekemia that was acquired by a private equity fund. He is also a Kaufman Fellow and is currently the last few years started a venture fund, doing venture a little bit differently. So we'll hear more about that, called Nobel Growth Partners. So if you can share with the audience a little bit more, what is Nobel Growth Partners?
Definitely, and thanks for that kind introduction. So yeah, Novel Growth Partners is a venture firm based in Kansas City, as you mentioned. We focus on providing growth capital to companies, in particular in the software space, that have at least $500,000 of revenue or more. And we take a little bit different approach, as you mentioned. We use revenue-based financing as the instrument. And for the folks that are not familiar with revenue-based financing, when we make an investment, unlike the traditional venture equity model in which you make an investment for a percentage of ownership of the company with the hope that the company will sell in the next 5-6 years to get your return, with revenue-based financing, we're able to make the investment and take a return as a percentage royalty of the revenues or cash proceeds of the company up to an agreed return. And that gives us much more flexibility with the number of software companies that we can work with, because we don't require that kind of super high growth, and gives us more flexibility to work with more entrepreneurs and to be more flexible as well with the types of entrepreneurs that we work with.
Amazing. And you've invested in about 22 companies, $9 million or so to date. So can you share a little bit more on what you look for in a startup? What types of founders should come to you? Is there a particular industry of focus or stage?
Yeah, and actually, we've been moving so fast that we're pretty excited to share that we just closed on our 25th company,
Oh,
actually
okay.
this last week. So
Awesome.
yeah,
Great.
so things are moving fast here. So
It's
um,
faster than your bio update. So
faster,
apologies for that.
exactly. You know how it works, right?
I know how it goes. I know how it goes. So
The
no,
last
thank you
thing
for
we
that
have time
correction.
to do is the marketing or those types of things. But no, good thing. So to your question though, so we focus on B2B software companies, like I said, that are the earliest stage. So given our model, they have to have revenue. So $500,000 is the minimum. So some of the other key kind of quantitative elements that we look at is companies that are growing at about the 30% or so a year over year growth. So we don't require that 100 plus, 200 plus growth year over year, which gives us the flexibility to work with more entrepreneurs, like I said. We don't focus on a particular vertical, so we are able to work with really any type of B2B software company. Now, given that my background is in the education space, I have a little soft spot for that, and obviously know the industry very well. So we have several education companies in our portfolio. And then the other thing that naturally seems to work well is for industries that require a little bit more patient capital, right? So like healthcare, ed tech, gov tech, things that sometimes it doesn't matter how much money you put into them, that they need just a little bit of patience to go through regulations or to go through piloting of the software. So those industries seem to be a natural good match. But again, we have companies in the healthcare space, we have companies marketing tech, and other areas. So we think that if you have kind of the right underlying elements from a quantitative perspective and your software, we can generally work with you.
Amazing. And you mentioned your ed tech background. So I want to, can you share a little bit about with the audience on uh, Netkemia. What was Netkemia, and how did you come about starting Netkemia?
Yeah, so right after, as I was finishing my MBA, I got the entrepreneurial bug and decided to start early 2000s, what started as Netkemia, as an internet consulting company, and just doing all kinds of e-commerce and automation projects that would pay the bills. And in that process, a couple of years into it, we had an opportunity to go as a possible customer to visit a large metropolitan school district HR office. And in conversations with them, one of the things that one of the secretaries said is that all the boxes we were seeing around and file cabinets. I was asking, what were those? And they said that they were basically the applications they had for teachers and staff for the school district, and that the best chance for a teacher to get hired was that their application was at the top of the pile because they're just never going to get through all of it, right? And that just kind of floored me that that was the state of what I consider was a very large, very well-resourced school district, that they were just kind of being inundated by paper. And we had further conversations, decided that we were if we would be able to help them, but that really opened up the evolution that got us into being a software company in the edtech space, and eventually built a full talent management platform for school districts that, as we used to say, allowed you to manage, from hire to retire. So everything from recruiting, hiring, professional development, performance evaluations, and personnel records management for education. So did that for 15 years. So.
Yeah, and that's the next part. I was going to say 15 years in the ed tech space. How how did you, was that what you intended to start building when you sought out, you said you started in consulting, like how was it set, like selling into the K through 12 space? How did you get that initial traction, and why did you focus on the education market?
It was very opportunistic. We saw something that we could do. It seemed like more people, more school districts, that they found out what we had done, saw that as a product that could help them solve some of the challenges they had. And slowly we started understanding the market, understanding the sales cycle. But yeah, it was very difficult because my background was originally computer science and math, and um, uh, maybe some other folks that have that technology background might relate, but usually sales is not one of those things that you gravitate to or that you love. And it's usually like a black box that you don't know why it happened or why it didn't, or sometimes could be very frustrating. But because we were growing mostly organically, and it's part of the story actually that brought me here is we had challenges fundraising in the middle of the country. Kansas City 15 years ago or so didn't have a lot of options for capital. And actually, as we were growing the company, we had gotten some success, about 100 customers that we had after a few years of doing it. And some mentors and folks that I consider were wiser than me at that point told me, well, you're a software company, you're trying to grow faster, you should go raise money. That's what folks with software companies, software entrepreneurs do. And even taking some of my lessons from my MBA, the first thing I did is I wrote a business plan, and I went to a bank and took my friendly banker and say, I have customers, have this great company that I'm doing, here's my plan. And they said, you don't have collateral, you're not profitable yet, sorry, right, can't help you. And so then started doing the rounds with my pitch deck, and when I visited a bunch of angel groups, other VCs in the area. And at that point in time in particular, the sexy thing was, e-commerce or consumer apps. EdTech was not really something that people were jumping up and down to hear about. So we got a lot of no's for about 8 months. And after 8 months, ended up empty-handed. So that was my first experience fundraising. And we know we had to go back to square one and basically say, hey, how do we keep growing organically? And the answer was, we got to get better at sales, right? We got to generate revenue. And in a way, I'm a little bit thankful for the experience, because we ended up getting good at sales. It took a little bit, it took patience, but that's eventually what helped us grow.
That's amazing. And it seems like now you're helping the companies similar to yours, right? That they might have that steady, consistent growth, getting capital where it's needed. Can you share, how did you end up, you were building this company, 14 years in, what made you want to sell it to Vista Private Equity?
Yeah, it was just a very good opportunity. We eventually, after growing organically for many years, ended up raising a decent size A round from a San Francisco firm, and with that we made a couple of acquisitions, continued to grow the company, and I saw that there was really a large opportunity. I think at that point we had almost 2,500 school districts across the country as customers, and the industry was consolidating from many small players, and you were either going to be one of the small players or you're going to be one of the big ones. We were successful with the initial couple of companies that we bought, small companies, and the integration process. And I thought that was a good strategy to continue. Obviously, we didn't have the capital to make those larger acquisitions. And when Vista came and they had a thesis to, as I learned, of buying software companies as platforms and then acquire other companies in the space to continue to grow. That's what I was trying to do. They had the capital, we had the understanding of the market and the same strategy, and it just seemed like a great match.
And why that's no, that's great. It sounds like they came knocking, and it was just the right opportunity.
Yeah.
Why Kansas City? You mentioned a lot of the funding is on the coast. What spurred Kansas City? I know you did your MBA there, but
Yeah.
yeah, you could share more.
Yeah, I'm originally from the highlands of Bolivia, from La Paz, and growing up, I was always into computers, and it was I had the desire, the dream to originally to come study computers in Miami, and long story short, I had an uncle, my mom's brother, living in Kansas, and he was kind enough to offer me free room and board, and so a part of my original dream came true. I came to the U.S., but I missed Miami by a little bit. Ended up in Topeka, Kansas originally. Some of you might have heard of it, the capital of Kansas, small town, and then eventually, yeah, made it to KU.
Amazing. And what are some of the things that are unique about the Kansas startup and entrepreneurial ecosystem?
Yeah. Well, in many ways, it is unique compared to the coast, right? It's definitely a much smaller market. But what I've learned, I think, over time, and you hear sometimes now, being definitely in contact with many entrepreneurs and even growing a company, you sometimes have that concept of, well, if I be in the coast, it'd be so much easier. Entrepreneurs in the Midwest are so risk averse, and so you hear these things, and at some point you kind of believe them, and maybe it's just rosier, and easier in other parts of the country. But I think I had the fortune to Kaufman Fellows, to meet obviously investors from around the world, and just to my experiences as an entrepreneur, visit many parts of the country, and one of the things that I noticed over time is that it's not that different. I mean, Silicon Valley is pretty unique, right? You got New York, Boston, you have some markets that are large and really have a lot of opportunity. But once you get past that, really, I was in a conference in Miami a couple of years ago, and heard some of those similar things from entrepreneurs in Miami, right? Miami investors prefer real estate. They don't know tech. They are risk averse. Through Kaufman Fellows, I was in a conference in Tokyo last year before the pandemic. And similar things, right? That Tokyo entrepreneurs, Tokyo venture capitalists are risk averse, right? The same story as in Kansas City, you're here in Miami and in Tokyo. So you realize, I mean, at the end of the day, entrepreneurship is hard. Fundraising is hard, right? I've raised now money as an entrepreneur, as a fund manager. It never gets easier. It's the way it is. And so you just come to kind of realize and accept that at some point.
That's great. Are there particular industries, or even though it's tough in the Midwest, is there a particular industry of focus, I start to think about investment ecosystems like LA,
Yep.
right, has a lot of
Yep.
media and entertainment. There is a lot of art and
Yep.
also Latin American influence in Miami, as you
Hmm.
mentioned. Um, is there anything particular about Kansas
Yep.
that you think is different than other ecosystems?
Right. Yeah, there's definitely certain industries that can benefit from the ecosystem. So there's definitely strong ties to agriculture. So ag tech is strong. There are definitely a related side is some biotech or animal health that is strong. And then interestingly enough, engineering and construction is also another area in which there's a lot of companies and that are trying to innovate. And then, if I expand a little bit more, even if you consider, the Kansas, Missouri, Nebraska, you get, and even if you go to Indianapolis, strong fintech or banking types of institutions that are trying to innovate. So there's definitely some markets that have certain mass, if you will, where you can do something.
No, and I really like. I think. I mean, there's a combination of things. Like you're saying, there's an expertise, right, in the region, and sometimes the capital doesn't get there, and you're providing that service. How did you go from now selling your company, right, and probably wanting a much needed break, and saying, oh, I want to do it again, but I want to start a fund. Like what can you walk us through that what inspired you to go from like selling that to starting Nobel Growth Partners?
Yeah, as you said, I took a few months, which I was intending to take a whole year break. I told that to my wife. I'll
It's,
kind of
it's
reconnect with people.
I
I'll
was
take
like,
a whole
you're a
year.
real entrepreneur. A couple months, and you were like, all right, let's get back to
Yeah,
it.
my wife knew better, I think, and she's like, sure, yeah, a year. And yeah, after 3 months, started to get some ideas. And one of the things I started to do was make some angel investments just with my own capital, and trying to support entrepreneurs that I knew in the ecosystem, and companies that I was excited about, and started to build a portfolio that way. And what I started to notice was that the challenges that I had growing my company and fundraising uh, continued to be similar, 10 plus years later. Entrepreneurs were complaining about the same things, and investors were complaining about the same things. That is like, we're not finding any good companies, right? And entrepreneurs saying investors are risk averse. And what I saw was really partly a little bit of a kind of everybody missing each other, because investors were looking for uh, different characteristics in the companies, and that's why they weren't finding. And entrepreneurs were looking for a certain type of investor and a certain type of capital for things that they didn't have. And so there was just a little bit of a mismatch, rather than not good companies or not good investors. And in thinking about that and my experience, part of what I realized is, well, if somebody is looking for venture type of returns, but there are companies that actually, there are good companies that provide good returns, 30-40% growth, which is not trivial to do, especially as you grow. Then there might be an opportunity there. And I was fortunate that I ran across with my co-founder now, Keith Harrington, and he came more from the traditional venture side. Here, he was a VC for many years, and had gotten tired, in a way, of saying no to a lot of entrepreneurs of the region. And not only he could not invest in them because they didn't have the returns and growth that he expected, but also he didn't know where to send them. And he was trying to solve that problem after leaving his last firm. So there must be a solution to this, or who has solved this. And he was doing some research with the Kaufman Foundation, that we're very fortunate that happens to be here in Kansas City, about 10 minutes from our office, and uh, identified revenue-based financing as a possibility to help more entrepreneurs, in particular in the Midwest, but that could apply to others. And as we reconnected and he ran the idea by me, I said, well, this is a great idea. I never heard of this. And if I had, his question was, as an entrepreneur, would you have thought of this as a good opportunity for growth capital? And I said, definitely. And then we continued to hash the idea, and eventually say, hey, it seems like this is something that we have to do. And that's how Novel Growth Partners started.
That's amazing. So and coming up with this model, I know, it's pitching to, Robo One is like where we pitch to LPs too. We know, we understand, it's tough to raise capital even as a venture capitalist.
Yep.
How was it pitching this alternative model? How did you like break in and really get that initial adoption?
Yeah, jokingly, sometimes I say that some entrepreneurs, I think it's harder than when you're fundraising as an entrepreneur, because it's a little bit of an intangible. As an entrepreneur, sometimes you can see the product, or some people are passionate about the problem you're solving. As a VC, as a little bit more intangible, and definitely being a first time emerging manager, uh, you know. All kind of my entrepreneurial experience got discounted, right? Because it's like, it doesn't matter that you were an entrepreneur, that you are a brand new fund manager, you have not done this, and you don't have returns, and you don't have a fund history that you can show me. And so you're basically starting from square one. So yeah, so it was definitely challenging, from just being a first time manager. But then it added, I think, a little bit of complexity to say, oh, and by the way, we have this other instrument it's a little different animal that you've never heard about, and trying to identify the right type of investor that believed it was, a worthwhile fund and instrument. I think was a little bit of challenging, but it also, I think, gave us more confidence once we were able to get the fund up and running.
And there are a few funds that are coming up with alternative methods, right? And
Yep.
and this is where I think about Collab Capital, and I would almost argue you're focused on companies that are growing, 30 to 40% year over year. That's probably what not it's not what the financial models say for a lot of the investments, but probably where some of the good ones end up.
Yep.
either way. So shifting it, and taking a step back, what are things that you like, what are alternative models that you think are going to be more of the future of venture capital as we push to try to create access, right? Like the
Yep.
old model of I invest just for equity is pretty similar to what's been done for the past 40 years, right? Like, so, if you have shed some light on that, like, do you think the revenue based financing is one area? What are other areas that you think are promising within venture?
Yeah, and I think the underlying challenge, and as we started Novel, one of us, and being kind of more the analytical side, one of the first things I wanted to was cross-check myself. Is it just this qualitative feel that I have that, there's entrepreneurs that need help, and there's other ways of capital that could be applied, or is there really some data behind it? And again, we were able to leverage some of the work that the Kaufman Foundation has done, and then some other data. And when you look at the data, right, you find out that for the last 5-6 years, um, between 5 to 6,000 companies in the U.S. get institutional financing, venture financing. And so that's less than 1% of the 500,000 to 600,000 new companies get started. So just mathematically, that 99% of companies are not going to get venture finance. They just don't meet the criteria, right? And it's fine. And then even when you look at banking and other traditional institutions, those cover another 12 to 15%. Let's round it up to 20%. So where are the other 80% getting growth capital? And that's where I think, as technology is advancing and people are realizing that, then they're saying, well, what are other innovative ways that both provide returns to the investors, but also work with the entrepreneurs? And to your question, I don't know if I don't know exactly what are going to be the things that 10 years down the road we're going to see as the new um, areas that have evolved, and maybe it's what seed stage at one point was, right? Which it took 10 years or so, and now you see how many seed managers there are. So maybe revenue financing is one of those. Maybe there are other areas that come up, but I think where I would agree with you is that definitely there's innovation in the space, and in a sense, we like to call ourselves capital entrepreneurs. Is just trying to figure out how do we serve all these types of entrepreneurs that have different needs, and they have this set of criteria under which they are working, and so there's just not a one size fits all.
Yeah, and even though you're agreeing for payback up to a certain multiple, how do you think about that compared to conventional venture capital returns?
Well, we're definitely, from a cash on cash perspective, we're looking at returns normally of 1.5 to 2x. So when you think about the cash on cash returns that equity VC is normally looking, 10x at a minimum, right? 20x plus. So from that perspective, we're looking basically, in our case, in our model, because those returns are lower and are capped basically, right? I'm not going to get ever more than that 2x, call it. Um, each one of our companies has to be successful, right? I cannot say, okay, maybe some of them are going to go under, and that's okay because some of them are going to make up for those returns. So I have to be much more careful around my portfolio selection and build up. And so just kind of the way you look at the model is just different, right? And but at the end of the day, at a portfolio level, we're looking at returns that are meaningful for our investors, because otherwise, as you well know, if we don't do that, we're not going to be here for very long, right? You still gotta provide the returns to the investors to the level that they expect compared to the risk.
Yeah, it's great that you speak about that, because even about investing up to a certain multiple, because I've seen some models like you said 2-3x, even in the 3x. People don't realize, even though you mentioned 10x is conventional venture, well, like that's what they're aiming for.
Right.
But if 8 out of 10 of them die, right, and that 10x averaged out is may even be less than what you're getting, right, across, if you inch up to 2 to between 2 and 3, you're actually top quartile in out of all of venture. So there's something to be said there for alternative models, not only meeting the needs of the market, but this the returns may be even better. So it's that's
Yeah, we definitely agree with you, because again, that there's the what a lot of venture funds are aiming, but then there's the reality of how many really accomplish that, and there are very few that can get there on a consistent basis also.
Yep. It and right now, I know you focus more on early stage B2B. What's next for Nobel Growth Partners? Where do you all want to go in the future? I know you've been doing this for over 3 years now, but what does the horizon look like for you all?
Yeah, in the near term, right. So when we started, the thesis was mostly around helping companies around the Midwest. I think over the last even year, we've seen that the opportunity is really not just geographical. So yeah, there's obviously a need around the Midwest for additional capital, but what we've really seen is more of a stage or timeline part of the growth of a company that is the match to our model. So we've really seen a lot of opportunity just across the country, and just recently we've completed a couple of investments in Canada, and so in the near term, it's really getting our brand to be known, at the national level. And again, I think there might be good opportunities even in Canada in the near term. And then going past that, we see that there are opportunities to apply the revenue-based financing model. Obviously, there's going to have to be some tweaks to it, but to other models, right, that are not just pure technology. So again, right now we're focused on B2B software, but clearly opportunities around the products that have hardware. There's a little bit more complexity there, because you gotta deal about inventory and other elements there. And then maybe B2C, and even eventually maybe looking at things that don't necessarily fall right into the pure technology stack. maybe things that are more tech-enabled services, or even, we've gotten outreach, interestingly enough, right? So once you set up shop, you start getting outreach from everywhere, and so we've gotten companies that do that are totally outside of tech, that have good revenue and customers. I think one was doing towel warmers for hotels, right? And good revenue, good growth. And we just kind of sticking to our thesis, we had to say no. But I was looking, at the basics of the company. I was like, this is really like a good company, right? And so again, we're plenty busy with what we're doing right now, but we think that there are opportunities in the future to cover and help other entrepreneurs.
That's great. And I love, like you're saying, like you highlighting entrepreneurs that might not be building the sexiest thing like towel warmers, right? But you're saying makes money, good business. Like there are customers, it's growing, right? There's for a lot of the entrepreneurs out there, sometimes keeping it simple is a powerful mechanism to build wealth, sustainably over a period of time. I wanted to say thank you very much for joining us, our audience. This is Carlos Antequera, co-founder and managing director of Nobel Growth Partners. Thank you for sharing your story with us today, and please tune in next week to listen to more amazing VCs and CEOs. And have a good night.
Thank you so much.